Hello, this is Quad G with Major Market Movements. This is my video blog entry for July 24th, 2014. In this entry, we're going to take a look at the Dow and also negative divergences in the RSI and MACD as well. Two very common oscillators that are used in technical analysis quite frequently. And one of the ways to look at the RSI and the MACD is watching for what are called negative or positive divergences. Now you'll see here in this Dow chart, we got the price of Dow on the chart moving up, but also I've got the RSI 14, the relative strength index, with the 14 period scale at the bottom here. So one thing to do with oscillators, especially the RSI and the MACD, is watch for negative or positive divergences. In this case, we have a double negative divergence taking place in the RSI. And what I mean by this is, if you look at the price, we've got 1, 2, 3 different swing highs here. And you can see between this high and this high, the price has definitely gone up. But if you take a look in the RSI, you can see that we've made only a lower high in the oscillator while making a higher high in price. This is a negative divergence, and this can oftentimes be an indication of topping action in a market. The same applies for positive divergences with the market working on a potential bottom. It would basically be the same thing, just inverted, flip-flopped, as a market was trending downward. So it's a double negative divergence because the next higher high in price is above the last swing high, but here again we have another lower high in the RSI, in the oscillator. So why is this important? Why even pay attention to this? Well, let's go back and review some history, and I'll show you why negative divergences can be very important. Here we have a negative divergence here, just a single one, almost a double if this had made a slight higher high. But as you can see, we have a lower high in the oscillator, in RSI, and then the price and the oscillator start moving down. So this was an indicator that the market was weakening and ready for a correction. Another thing I want to point out is oftentimes there's an accompanying trend line in the oscillator that should be watched. And the reason it should be watched is if you have a negative divergence in the oscillator and the oscillator comes down and breaks that trend line, not just bounce off it, but actually get a nice break of it, even if it pops back up. That break is an indication that this is some substantial follow through, and it could lead to even lower lows. And in this particular case, we did have the negative divergence. The price did come down. Also, I should point this out. I didn't think about this till just now, so pardon me. But here's another very important, let me choose another color. Another important part of oscillator watching that is very good to pay attention to. And it's one part of oscillator divergences that most people underlook or don't realize, is we've got actually two negative divergences here. First, we have this leading divergence with the negative divergence on the top side, but then we also have a negative divergence on the bottom side. And what I mean by that is, with this move down out of this negative divergence, the price came down and it made a lower low in the oscillator. Not a lower low in the price, but a lower low in the oscillator. So this reinforces the idea that this is a top is taking place here. And sure enough, we did get the negative divergence on the following side, the lower side. It popped up a bit. That provided a nice shorting opportunity, and then it fell down from there. So let's back up a little bit further. And here's another double negative divergence at the 2007 top in the Dow. Here we have a higher high, another higher high in price, but lower lows, or lower highs, excuse me, in the RSI. And then finally, once the price started coming down and we broke the orange trend line, that was it. We had a break of this trend line. The RSI came up, back tested that trend line right here, providing a good shorting opportunity. And then looks like just that week also ended up giving us a outside key reversal there on the weekly, and then it fell down from there, and it just produced lower lows and lower highs from that point down. So really good reason to be paying attention to those negative divergences. Now, negative divergences don't always succeed. Sometimes they'll fail, but it is a time to be to have our awareness heightened to the potential of a topping action. And here's an example of a double negative divergence. It started to produce some downside. It did break the lower orange trend line here of the previous lows. It did break. It looked like it might have been falling down, but it popped back up and recovered since. So that was a negative divergence that didn't succeed. But then it was followed up later with another negative divergence, a break of the orange trend line, and this was back in the 2000 top, and it drilled down from there for several months. Okay, so this is all on the weekly scale, and the same thing can be applied to the daily scale also. Let me put this on here. And not just daily, you could go into 4 hour, 2 hour, 1 hour, 15 minute. It all applies. So here again, we have a double negative divergence for the most part. We've got this higher, we got a higher high in price, lower high in the oscillator. And we're still riding above this orange trend line. Still haven't broken it yet, and I suspect that once that line's broken, it's going to start sliding. And I have some other ideas on why it's going to slide fairly well once that lower orange trend line is broken here in a minute. Okay, so this is all looking at the relative strength index, the RSI 14. So let's go ahead and move to the MACD. And you can see the same thing is taking place on the weekly chart for the MACD. We have this double negative divergence. We got a lower highs in the oscillator, and then higher highs in price. Now, I suspect that once the MACD curls back over, the signal line passes back through the baseline, the signal line being the blue line and the baseline being the orange line. That's going to be our signal that this double negative divergence could be done, and we could head off into a correction. And that's the weekly chart, and you can see pretty much the same thing taking place, almost a triple negative divergence taking place here between these highs here. So there's other oscillators this applies to as well, but RSI and MACD are pretty much the mainstays that most people use, and they are oftentimes very effective. Now, to give you a brief look at where I think we are with a short-term Elliott wave count, as I see this choppy move up in the Dow as an ending diagonal type count, and the count is technically full right now with 5 sets of 3-wave moves, and that's what makes up an ending diagonal. The other thing that an ending diagonal needs is a tapering action. The price should be converging into a tighter and tighter range. And then once the lower trend line here of the ending diagonal, which has been tested 1, 2, 3 times, I suspect that once the fourth time is hit, we could get a sell-off, a rule of 4 breakdown at that point. So something to watch for, and you'll notice time if you're paying attention to Elliott wave counts, especially ending diagonals, you're going to find that the negative divergences taking place in RSI and MACD are usually accompanying an ending diagonal type pattern, or on the flip side, a positive divergence. You're going to see in the oscillators too, with an ending diagonal to the downside. Okay, so that's my brief overview of the Dow and negative divergences in the oscillators. I hope this is a benefit to you. Good hunting out there, and we'll talk to you later. Adios.